Did you know that the iconic Warren Buffett, a man who turned picking stocks into an art form, deliberately steers clear of one of the world's most famous brands, Nike? Yes, you heard that right. The same brand that probably graces your shoe rack doesn't find a spot in Buffett's billion-dollar investment portfolio. So, what is it about Nike that doesn't quite fit the Buffett-Munger investment puzzle? Is it the swoosh, the strategy, or something entirely different? Well, without further ado, let's find out.
So you're really asking about the future prospects of Nike and Reebok? Yeah, I don't know that much about those businesses. We do have one person in this audience at least who owns a lot of Reebok, but I'm not expressing a negative view in any way on that. I don't understand their competitive position and the likelihood of permanence of their competitive position over a 10 or 20-year period, as well as I think I understand the position of Brown and Dexter. That doesn't mean I think that it's inferior. It doesn't mean that I think that we've got better businesses or anything. I think we've got very good businesses, but I haven't done the work, and I'm not sure if I did the work I would understand them. I think they are harder to understand, frankly, and to develop a fix on than our kinds. But they may be easier for other people who just have a better insight into that kind of business. Some businesses are a lot easier to understand than others.
Let's talk about a more iconic partnership than peanut butter and jelly, Warren Buffett and Charlie Munger. These two weren't just business partners for nearly half a century, they were the best of friends, with Munger being the rare soul who could tell Buffett, "Hey, you're off track here." Can you imagine having the guts to say that the greatest investor of all time, with his whopping $120 billion fortune, is wrong? That's Charlie Munger for you. A man not just wealthy in his bank account, but rich in conviction. Sadly, we lost Munger just before he could hit a century. But boy, did he leave a legacy. Joining Buffett in the mid-1970s at Berkshire Hathaway, he was the yin to Buffett's yang. Picture that Buffett comes up with an idea, and Munger, like a wise sage, gives it the thumbs up or down. And believe it or not, Buffett loved it. He even had a nickname for Munger, the Abominable No Man. Thanks to this dynamic, Berkshire Hathaway thrived, making its shareholders dance all the way to the bank. Now, on to Buffett's golden rule. Never invest in a business you cannot understand. It's like choosing a book. If the summary doesn't make sense, why read it? Buffett's investment strategy is all about clarity and foresight. He's not about the quick cash grab. He's in it for the long haul. Now, here's a Buffett gem to chew on. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. This isn't your typical Wall Street sprint, it's a marathon. So, how does the Oracle of Omaha sift through the endless sea of stocks? He's not just looking at today or tomorrow, he's gazing into the crystal ball, trying to see where a company will stand a decade down the line. It's not fortune-telling, but pretty close.
Charlie and I don't like difficult problems. I mean, if something is hard to figure, we'd rather multiply by 3 than by pi. I mean, it's just easier for us.
Picture Buffett at a 2001 Berkshire Hathaway meeting, where a shareholder asks, "Why the cold shoulder to tech stocks?" Buffett's response is like a masterclass in investment foresight. He gets the product, sure, but what about the economics of it in 10 years? It's like trying to predict the next big hit on Netflix. Not everyone has the knack for it. Buffett's approach is a lesson in economic predictability. If you can't see where a business will stand years from now, it might not be the best playground for your investments. It's like setting up a lemonade stand and not knowing if your street will be around in a few years. Understanding the economics of a business is crucial. It's the difference between riding a winning horse and betting on a unicorn. Now, let's lace up and jump into Warren Buffett's thoughts on Nike, a giant in the world of sneakers and sports apparel. Now, when it comes to investing, Buffett is like a chef who only cooks with ingredients he knows well. And Nike? Well, it seems to be an ingredient he's unfamiliar with. Nike operates in the highly competitive and rapidly changing sports apparel industry. This sector is marked by fierce competition, fashion trends, and consumer preferences that can shift almost overnight. While Nike is a dominant player, the landscape is constantly evolving with new entrants and innovations. This could be a red flag for Buffett, who prefers businesses with predictable and stable markets. Investing in such a dynamic industry might seem like trying to navigate a maze blindfolded. Possible, but fraught with uncertainty. You see, Buffett is big on understanding a company's competitive edge, something he refers to as the moat. Just like in medieval times, where a moat kept castles safe from invaders, a moat protects a company from competitors snapping at its heels in the business world. Buffett's investing strategy is all about identifying companies with a solid, unshakable moat. He believes that the secret sauce to above-average performance in the long haul is a sustainable competitive advantage. The stronger it is, the less likely they are to get knocked down.
Well, that is such an obvious point, and yet so many people think if they just hire somebody with the appropriate labels, they can do something very difficult. That is one of the most dangerous ideas a human being can have.
Now let's bring in Charlie Munger's wisdom. He once said, "We have found in a long life that one competitor is frequently enough to ruin a business." It's like being in a boat race. One strong competitor can quickly capsize you. This is where the moat comes in. The life jacket keeps the business afloat even when the waters get rough. Buffett gives a shout out to some of the Moat Superstars. Take Geico, for example, with its discount model that leaves competitors eating its dust. Or Costco, where the value for money is so good, it's like finding designer clothes at thrift store prices. And who can forget Coca-Cola? Despite all the taste tests, debates, and new kids on the block, Coca-Cola stands tall, almost like the king of the beverage world. It's not just about the taste, it's the brand. It's like having a loyal friend who's been with you through thick and thin. That's Coca-Cola for its customers. High prices? No problem. The fans just keep coming back for more. It's the same with American Express, which has crafted a premium image that attracts the affluent like bees to honey. These examples, like Coca-Cola and American Express, aren't just businesses. They're fortresses with moats so wide and deep, competitors can't even get close. This approach has stood the test of time, proving that a strong moat can keep a business thriving. So, why hasn't Buffett invested in Nike? It seems he's not quite convinced about the durability of Nike's moat. In the investment kingdom, understanding your castle's defense is key. And for Buffett, Nike's moat is a bit of a mystery. In the world of investing, it's not just about the size of the company, but the strength of its walls, or in this case, its sneakers. Moreover, there is the concept of value investing, a cornerstone of Buffett's and Munger's strategy. They look for undervalued stocks with strong fundamentals, essentially buying a dollar for 50 cents. Nike, with its strong brand recognition and high market valuation, may not fit this criterion. Its stock is often priced with premium expectations, leaving little room for the margin of safety that Buffett so adamantly advocates for. This mismatch between Nike's market perception and the value investing principles could be another reason why Buffett and Munger have steered clear of it. And there you have it, folks, a journey through the minds of the greatest investors of our time, and their intriguing stance on one of the world's most recognizable brands, Nike. But if Warren Buffett and Charlie Munger's strategies have steered clear of Nike, what does that say about your own investment strategies? Are there Nikes in your portfolio that perhaps warrant a second look? Comment down below, and thanks for watching.